welcome to the deep dive. Today we're looking into CoreWeave. They're a cloud infrastructure provider, but with a real focus on GPU computing, especially, for AI.
Exactly. And we've got some good sources lined up. Their latest Q1 2025 earnings report, a pretty sharp analysis from Guru Focus, and also a really interesting discussion over on Reddit, Larstox, about their IPO. Lots to unpack.
Right. So our mission here for you, the learner, is to really get a solid grip on CoreWeave's business, check out their recent financials, understand the buzz around the IPO, and, crucially, figure out the key drivers and risks, all without getting too bogged down in the technical weeds.
Sounds good.
Okay, let's start at the beginning then. What is CoreWeave exactly?
Well, think of them as an AI hyperscaler. That's the term they use. So you know AWS, you know Azure.
Yeah, the big cloud players.
Right. CoreWeave is kind of like that, but they've really zeroed in on renting out massive amounts of GPU power, graphics processing units. These are the things you absolutely need for heavy-duty AI tasks.
Like training those huge language models, or like generating AI art.
Exactly. Anything that needs that serious parallel processing muscle that GPUs provide.
It's interesting, though, because that's not where they started, is it? I saw they were mining Ethereum back in 2017.
Yeah, that's right. Classic crypto story. Started mining Ethereum, then the market kind of cooled off around 2019. So they pivoted, turned their mining rigs into a GPU farm for general compute tasks. And by 2022, they'd fully transitioned into offering these GPU cloud services specifically for businesses.
So that early move, getting into GPUs before the huge AI boom, probably gave them a head start.
Absolutely. Being an early mover there, especially with the hardware relationships, that's a big advantage.
Yeah.
So how they make money? Pretty straightforward. Usage-based. Clients pay for GPU hours they use.
Like pay-as-you-go computing.
Exactly. Initially, they had clients in visual effects, rendering complex movie scenes, then interstellar level stuff. But now, the big growth driver is definitely AI, both training the models and then running them, which is called inference.
And they got some big names on board. I saw Meta, IBM, Microsoft.
Right, past and present clients. But the one everyone's talking about is OpenAI, a multi-year deal, potentially worth, get this, up to $11.9 billion.
Wow. Okay, that's enormous. So what makes them different from, say, just renting GPUs from AWS or Google Cloud?
Good question. They claim it's their custom software. They've got this scheduling system called S-on-K and an optimizer called Tensorizer.
S-on-K and Tensorizer. Okay.
Yeah, the idea is this software helps them use their hardware more efficiently. They claim faster container spin-ups, that's getting the computing environment ready, and higher throughput, so processing more data faster.
Which could mean it's faster or maybe cheaper for clients to train their models on CoreWeave compared to the big guys.
That's the pitch. Better performance, potentially lower cost for these specific demanding workloads. It's not just the hardware, it's the software stack on top.
Got it. And the scale they're operating at now.
Yeah.
It's pretty significant, right?
Oh yeah, we're talking 33 data centers, over 250,000 NVIDIA GPUs. And these aren't just any GPUs. They've got the top-tier stuff, A100s, H100s, even the latest H200s. Plus, they seem to have a really strong relationship with NVIDIA, like a priority line for getting these chips.
Right, the NVIDIA connection, that seems key.
Yeah.
NVIDIA isn't just a supplier. They've actually invested in CoreWeave.
They have, which, suggests CoreWeave probably has a pretty secure supply of those GPUs, which are like gold dust right now.
But isn't it a bit weird that NVIDIA is both an investor and a customer? Why would NVIDIA rent compute from them?
Yeah, that comes up. The thinking is, even NVIDIA, when demand is absolutely through the roof, might need extra capacity sometimes. We've heard Microsoft does it, NVIDIA themselves apparently do. And of course, OpenAI, their huge customer, needs that capacity.
So it's like overflow capacity, even for the chipmaker itself.
Possibly. And there's that strategic angle, too, the one from the Reddit discussion. Maybe NVIDIA wants CoreWeave to succeed to keep AWS from totally dominating the AI cloud space. A bit of competition.
Keeps the market healthier, perhaps. Okay, let's pivot then. Let's talk financials and the IPO. Because the revenue growth, it's been explosive.
Absolutely staggering. I mean, look at the numbers. 2022, they did about $15.8 million, and a lot of that was still crypto.
Right.
Then 2023 jumps to $229 million, and then 2024, $1.9 billion. Almost $2 billion in annual sales, basically, within 2 years. The demand after ChatGPT just lit a fire under them.
Incredible acceleration.
Yeah.
But that kind of growth costs money, right? What about profitability?
Yeah, that's the other side of the coin. They've been posting pretty big losses, around $600 million loss in 2023, and then roughly $860 million loss in 2024.
Wow. Where's that money going?
Massive investments, building out those 33 data centers, buying hundreds of thousands of very expensive GPUs, plus all the operating costs that scale up with the business. They're burning cash.
So it's that classic tech playbook. Spend big now, grab market share, hope for profits later. Like the Reddit folks compare them to Uber or Snowflake in their early days.
Exactly. Bet on the long-term contracts and economies of scale kicking in eventually. Which brings us to the IPO.
Right. They went public recently. How did that go?
Well, they sold 37.5 million shares at $40 a pop, raised $1.5 billion, valued the company at $20 billion, but that was actually below their initial target. Reports suggested they were hoping for maybe closer to $32 billion.
So priced lower than hoped. What does that mean? The Reddit chat suggested maybe good for short-term traders, less good for early investors.
That's one interpretation, yeah. IPO pricing is always a bit of a dark art, but how does that $20 billion valuation stack up?
Good question. How does it compare to others?
Well, the Reddit analysis had some comparisons. Snowflake trades around, 15 times its enterprise value to revenue. Databricks, which is still private, maybe 20 times. AWS, being huge and mature, is much lower, like 4 or 5 times.
Okay, so CoreWeave at around 10 times revenue. Where does that sit?
Given their hypergrowth, maybe it's reasonable if they keep growing like this. Some speculated if they hit, say, $4 billion in revenue in 2025, thanks to that OpenAI deal ramping up, then 10x might even look cheap later.
Big if, though. What could slow them down?
Well, the overall AI market cooling off, tariffs, U.S.-China tensions may be affecting supply chains, although being a U.S. firm might actually help if there are chip restrictions on China, limits competitors.
True. So the valuation really depends on AI spending staying strong and companies continuing to rent rather than build everything themselves.
Okay.
And that other risk mentioned, what if NVIDIA floods the market with GPUs?
Yeah, oversupply would definitely hurt CoreWeave's pricing power. Another big one is customer concentration. Guru Focus highlighted this. Microsoft was like 35% of their revenue in 2023
Okay.
and jumped to 62% in 2024. Apparently, something like 80% of their revenue comes from just 2 customers.
62% from Microsoft. That feels risky, especially since Microsoft is building out its own huge AI infrastructure with Azure.
Exactly. That was a huge point on Reddit. People pointed to Microsoft's CEO basically saying using external GPUs was temporary until their own stuff was ready. Huge leverage for Microsoft in negotiations. Huge risk if they pull back.
Is the OpenAI deal big enough to offset that if Microsoft does scale back?
It could be. Remember, Microsoft owns a big chunk of OpenAI. If that $11.9 billion deal translates to roughly $2 billion a year for CoreWeave, well, that's basically their entire 2024 revenue right there. So potentially, yes.
It's still a bit of a high-wire act, though, relying so heavily on just 1 or 2 giants. Diversifying that customer base seems pretty critical for them long-term.
Agreed, which leads nicely into drilling down on those Reddit perspectives. It wasn't just numbers. People had strong opinions.
Yeah, what was the general vibe over there?
Kind of a mix, acknowledging the huge potential, definitely.
Yeah.
But also lots of caution. High risk. Many expected the stock might dip after the initial IPO hype.
And they raised specific concerns, right? Beyond the Microsoft dependency.
Yeah. Oh, yeah. There's that comment from a supposed former employee calling it a finance company pretending to be tech, run by finance bros, implying a rigid, maybe disorganized environment.
Though you could argue that's just a startup being serious about security and process, maybe.
You could. It's anecdotal. But other flags were raised, too. Debt levels, someone mentioned, a $7.6 billion loan, even claimed terms were breached.
That's a lot of debt.
And related to that, using GPUs, which depreciate pretty fast, as collateral for that debt. Some saw that as dubious accounting. Does the collateral hold its value long enough?
And the fundamental question,
Yeah.
do they have a real competitive advantage, a moat, against the big cloud players? Some skepticism there, too. Someone even suggested looking at a competitor, Nebius, instead.
Right. Plus concerns about the valuation being too aggressive, the whole AI bubble maybe thinning out, whether they can actually reach profitability and handle the debt. Even the founder's background in high-frequency trading got mentioned.
Sounds like a lot of skepticism. Were there any positive counterpoints on Reddit?
Yeah, definitely. Some argued the financials just look like a typical high-growth tech IPO scale first, profit later. Others focused on their core competency, supposedly delivering cheaper GPU compute through those software optimizations.
And the OpenAI deal came up again as a buffer against the Microsoft risk.
Frequently, that deal is seen as a major potential positive. But it's worth noting the stock's actual debut was seen by some as a bit underwhelming. Just a small gain on day one, not the huge pops some might have hoped for.
Interesting. Okay, so that's the market sentiment and the Reddit view. Let's look at the hard numbers from CoreWeave themselves, their Q1 2025 earnings. How did they actually do?
Very strong top-line growth continued. Revenue was $981.6 million for Q1. That's up 420% from Q1 last year. Matches the investor presentation figure, too.
420% growth still.
Okay.
Profitability in Q1, how'd that look?
Adjusted operating income was $163 million. It's up 550% year over year. Margin hit 17%. So operating margin improved. But their adjusted net loss was $150 million, much bigger than the $24 million loss last year.
Why the bigger net loss if operating income was up?
Higher interest expenses, that debt we talked about. So the adjusted net loss margin was minus 15%. Operations improving, but debt costs are hitting the bottom line hard.
Okay. What about adjusted EBITDA? That strips out interest, taxes, depreciation.
Right. That looked much healthier. $606 million in adjusted EBITDA, nearly 6 times higher than Q1 2024. And the margin was really strong at 62%, up 6 points year over year.
62% EBITDA margin is impressive. Shows the core operation is becoming quite profitable before financing and depreciation costs. Do they talk about future business? Backlog.
Yeah, a huge backlog, $25.9 billion,
Yeah.
up 63% year over year, largely thanks to that OpenAI deal again. That's split between $14.7 billion in what they call remaining performance obligations, basically contracted revenue, and another $11.2 billion in estimated future revenue from existing deals. Gives them some visibility.
A big cushion. But they're still spending heavily to build out, I assume.
Oh, yes. Capital expenditures in Q1 were $1.9 billion. Mostly data center expansion and deploying more GPUs. Cash actually paid out for that stuff was $1.4 billion in the quarter.
And the physical footprint keeps growing.
Yep. 33 data centers now active, about 420 megawatts of power running, but they have contracts for about 1.6 gigawatts of power. Shows the scale of future plans.
And how does CoreWeave see its own strengths? What did they highlight?
They emphasized being purpose-built for AI, that first-mover advantage at scale. There's software differentiation, having top AI clients operating at the bleeding edge, and having a systematic way to finance all this growth.
Okay. And did they explain how their contracts typically work?
Yeah, a bit. Typically, a client makes a prepayment. CoreWeave uses that to buy the infrastructure. It takes about 3 months to install. Then the client goes live, starts paying monthly over a multi-year term, usually 2 to 4 years, sometimes longer.
Got it. Okay, let's try to wrap this all up. What are the key takeaways for you, the learner, from this deep dive?
Well, fundamentally, CoreWeave is a major, fast-growing force in this niche of AI cloud infrastructure. Their revenue growth is undeniable, powered by the AI boom and that huge OpenAI partnership. They're offering a specialized alternative.
But, and it's a big but, there are challenges. Profitability is still elusive on a net basis because of those big investments and debt costs. They rely heavily on just a couple of major customers, which is risky. Plus, they've got significant debt and face intense competition.
Exactly. The official reports paint a picture of incredible growth and potential, but investor forums and analysis reveal real concerns about the valuation, whether their edge is sustainable, their debt load, and even some operational questions. It's a contrast.
So considering this massive AI compute demand, but also the risks of a highly leveraged, fast-scaling company like this, here's a final thought for you to chew on. What does CoreWeave's story tell us about the whole infrastructure layer supporting the AI revolution? And looking ahead in this really high-stakes game, who do you think the likely long-term winners will actually be?
Something to think about.
That concludes this deep dive. Thanks for joining us.